Fed will raise rates.
Rising interest rates.
To hiking interest rates.
Raise its key interest rate.
With rising interest rates, does that mean the adjusted rate of mortgage is the best option? I would say no. Surprised? I was surprised too when I saw the numbers. Compare the adjusted rate of mortgage versus fixed rate of mortgage. Adjusted rate of mortgage rate would vary once every 3 to 6 months, sometimes a year, before you reach your dream home. Everything shall change, even your home in a good way. With the fixed rate of mortgage, the payments would stay still even until your wish is fulfilled, even when the markets wouldn't agree with you over the course of 30 years. Now let's compare. Primary factors to consider are: how long would you keep the mortgage? What is the interest rate if the interest rates are too high? Will the interest rate stay high for too long? How do these factors impact our decision? If you're looking for 22 plus years or a 30-year mortgage, I would stay with adjusted rate of mortgage. In short, if the interest rates are too high and would continue to rise, I would strategize my plan by going with a fixed rate of mortgage. If there is a fear of recession, I would still go ahead with the fixed. To know why I stayed even with the high interest rates and a fear of recession, check my part 2 of the video. Let's listen to these before comparing them. In a fixed rate of mortgage, you lend the money from the bank to buy your dream home, pay monthly mortgage, and a part of the payment goes towards the principal, reducing your total mortgage, while the interest goes into bank's pockets. The good thing about the fixed mortgage payment is that your monthly payment is locked over a 30-year period of your mortgage, a reliable way to have your expenses checked, and the same mortgage across the tenure. But there is a risk of lock-in. I have a solution for that. Check the description how to save on high interest rates. Now let's check out the adjusted rate of mortgage. Adjusted rate of mortgage would vary primarily based on the Fed interest rate, probably every 3 months, 6 months, sometimes a year. And what banks won't tell you is what I'm going to tell you and how to avoid that. Your interest rate is fixed for the 5 to 10 years. This is kind of a deception the bank does. And they would charge a 2.5% additional over the Fed interest rates to protect their own money. This is common across the industry. They would use some terminologies like, hey, we have a 10-1 arm, 5-7-1 arm, which one would you like? Basically what it means is that the interest rate is fixed for 10 years, 7 years, or 5 years, and it only changes based on, say, 1 year or sometimes 6 months, rarely 3 months. So at the end of the day, what you're trying to get is close to a fixed, but then that would change sometimes in 6 months, sometimes in an year. So just be noted on that, friends. Let me explain you why a 5 to 10 year fixed in adjusted a major drawback. If you locate the percentage of interest paid by year in a 30-year fixed rate of mortgage, we are paying roughly 24% of the total interest in the first 5 years and 47% of the total interest in the first 10 years, which means we would have paid most of the interest by then. If you are looking for long term, something more than 22 years or so, I would suggest adjusted rate of mortgage, but there are a lot of ifs and buts. Let me know in comments if you want a financial comparison between them. A caveat here. In the past, interest rates have gone as high as 17%, which is $7,000 for a 500K home. And as part of my learning, I felt these are a must ask. After how many years would the interest rate starts to change? For example, in this, is it fixed for 10 years? Is it fixed for 7 years, 5 years? How many years is that? And how frequently would it change? Would it change every 1 year? Or would it change every 6 months or 3 months? And then a must ask question is that what is a cap on an increase or decrease of an interest rate per year and on whole term? When we ask this question to banks, the banks would say something like, we are at 7% and we could go as high as 11% and as low as 4% by the end of the year. And it could go as high as 14% and as low as 2% by the end of the loan tenure, which could be 30 years. So these are your numbers: 11%, 4% in a year, and 14% and 2%. And the most you care is the 14% and 2% in case if you're not going to refinance, which means you should be prepared for 6K for a 500K home. And as always, thank you for watching.